Hi, everybody, and welcome to TradeStation for this midday event that we're very happy to have Sean Feeney and Efram Slen with us today to discuss a topic that's very close to our heart, 2018, which ended with a volatility shift in response to some larger economic events. The question that still remains after all of that wreckage is, how can I protect my portfolio through those types of volatile periods? So today, Sean Feeney, the Senior Managing Director of U.S. Option Sales, and Efram Slen, the Director of Product Development and Global Index Research, will be with us to talk about the current state of the market, 2018's effect on the Nasdaq 100 index, and basic portfolio hedging strategies using the Nasdaq 100 index options. Remember that everything we talk about in this presentation is for educational purposes only. All the symbols, all the trading ideas, and everything that we discuss are for demonstration purposes. They are not recommendations, and this is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading is not suitable for everybody, and options trading unfortunately does carry a high degree of risk and may not be suitable for all traders. I've included in the chat panel a couple of very important pieces of disclosure information regarding the characteristics and risks of standardized options provided by the Options Clearing Corporation, and also another document outlining the other asset classes that we cover here at TradeStation. I urge you to take a look at those at your convenience. Now, if you are in the market for a Future Stars presentation, we have just what you want. The Future Stars 2019 panel will convene in Plantation, Florida, the headquarters of TradeStation, on March 8th, 2019, where you'll be able to jumpstart your futures trading after these fine presentations from Linda Bradford-Rashke, Raghee Horner, David Stendhal, Anthony Cardelli, Craig Bewick, Michael Burke, and Larry Williams. You can learn more about this event by clicking that button in the top banner, and think about joining us on March 8th in South Florida for Future Stars 2019. Now, also in March, if you have a week to spend in Florida and you'd like to learn how to use the TradeStation platform more efficiently and to beef up your trading, we have just what you need. The TradeStation Masterclass will allow you to master the TradeStation platform in just 1 week. From March 25th through March 29th, you can take a deep dive on the TradeStation trading platform, learn strategy development and testing practices, and learn how to use the Easy Language Fast Track programming functionality on the TradeStation platform. Join us for the TradeStation Masterclass, March 25th through the 29th, and in Plantation, Florida. You can go to the tradestation.com/master-class and register today. Which brings me to our presenters. Efram Slen and Sean Feeney are both going to be speaking on the same line. It'll look like Sean's there the whole time. We set up a special technology event for them. And guys, take it away. Thank you very much for coming to TradeStation in the middle of the trading day, but we are very happy to have the NASDAQ presenters with us.
Thank you very, very much. Once again, my name is Sean Feeney, Senior Managing Director of U.S. Option Sales here at NASDAQ, and I am joined by Efram Slen, Director of Global Index Research and Product Development, also here at NASDAQ. We also have a special guest today. That would be our disclaimer. We can't let the lawyers come into the presentation without getting their due, so for the sake of simplicity, the examples that follow do not take into consideration commissions or other transaction fees, tax considerations, or margin requirements, which are factors that may significantly affect the economic consequences of a given strategy. And investors should review transaction costs, margin requirements, and tax considerations with a broker and tax advisor before entering into any options strategy. Options involve risks and are not suitable for everyone. Prior to buying or selling an option, a person must receive a copy of the characteristics of risks and standardized options. Copies may be obtained from your broker or one of the exchanges or the OCC at 1 North Wacker Drive in Chicago. All strategies discussed, including examples using actual securities and price data, are strictly for illustrative purposes and education, not to be construed as endorsement, recommendation, or solicitation to buy or sell any securities. Nasdaq is a registered trademark, Nasdaq Incorporated. The information contained above is provided for informational, educational purposes only, and nothing contained herein should be construed as investment advice, either on behalf of a particular security or overall investment strategy. Neither Nasdaq Inc. or any of its affiliates make any recommendation to buy or sell any security or any representation about the financial condition of any company. Statements regarding Nasdaq-listed companies or Nasdaq proprietary indexes are not guarantees of future performance. Actual results may differ materially from those expressed or implied. Past performance is not indicative of future results. Investors should undertake their own due diligence and carefully evaluate companies before investing. Advice from a securities professional is strongly advised, and it is 2019. I'm going to throw it over to Efram, and he's going to do some discussion on the Nasdaq 100, and I will join you all later. And Efram, take it away.
Thanks, Sean. Happy to be here. Happy to be here with Sean, with the TradeStation partner that we have here with Nasdaq. And like Sean said, I'm going to kick things off, talk about the Nasdaq 100, give a description of the index, current market state analysis, really just give an idea of how that index performs and what drives it. And then we're going to hand it back over to Sean. He's going to talk about options and the Nasdaq 100 specifically, hedging strategies, and then we'll close it out with some Q&A. With that, really kicking things off, the Nasdaq, not even just the Nasdaq 100, we're really known for innovation and disruption. So when you think about our index business and the Nasdaq 100 in particular, those indexes really, when it comes to mind, just technology. So companies like Apple, like Microsoft, like Intel, Cisco, and then you got companies like Cisco and Amazon and Starbucks that really are innovating and disrupting in each of their respective industries. But at the core of it all, it's technology and technological advances, right? That's what I'm going to be talking quite a bit about over the next couple slides, and that's what's the driver behind the Nasdaq 100. It's not just that those companies are creating things that specific to their industry. You know, every one of these companies are creating things that generally are touching you in some form over the course of probably every single day. Myself right now, I have two Apple iPhones in my pocket. I've seen another one with Sean right in front of him. So we've got a lot of Apple products right around us. So I make that 4 iPhones. And we have some Dell products. We have a Cisco phone in front of us. And that's just literally in our room right here, giving an indication there. So the Nasdaq 100, give a quick index overview. So when people used to think of back about 100 years ago and talk about how the industry and how the markets were and how they were going to come and evolve, people used to really think, what are the industrials, right? The GEs, the Chicago Gases, American Sugars, and so forth. Those are the companies that were driving the industry, driving the United States and how we were propelling forward. But that has dramatically changed over the last 2 decades, specifically the last decade, with so much that has gone on with some of these great companies that I've already talked about that are listed here at NASDAQ. And those really are companies that have been in the Nasdaq 100 for the better part of a decade to 2 decades as well. So if you look here on slide 9, I have some great little picture graphs of some of those icons of some very well-known companies. And at the end of the day, the thing that's important to note is that the Nasdaq 100 is meant to represent the Nasdaq Stock Exchange. It's the largest 100 non-financial companies listed on the Nasdaq Stock Exchange. And some of those companies that are extremely well known are shown here, but there are many others that, and we'll get into that as well, that maybe you haven't heard of, that are actually helping drive and at times driving even more of the performance than some of those names like the Apples, the Facebooks, the Intels, and so forth. Thinking more about technology in life and how that's evolved and how that's transforming all of us, right, on a daily basis, and how things have evolved over the last few decades. I've got some interesting charts shown on here. So on the bottom left, it's looking at U.S. oil production, how that's actually come into play, and that's really a byproduct of technological advances. And similarly, in the top right, you actually have similar charts there. On the left, it's looking at CO2 emissions in both trucks and cars and both together. And on the right, it's the adjusted fuel economy in miles per gallon. And really, you can see the exact opposite is occurring in both charts. And that, again, direct representation of the technological advances over the last several decades. CO2 is going down in a huge way, and at the same time, cars and trucks are able to really get us where we need to go in a far less necessitative need for oil. Similarly, we've had other great technological advances, and some of those companies that have played a role in that are biotech, right? Companies that are making technological advances in the healthcare industry, but technology is the underpinning theme. And looking in the bottom right, you can see how the change in mortality rate from cancer over time has been occurring. Again, a lot of that has to do with some of the great biotech advances that have occurred. What does that mean for us today? And that's what we're here to talk about. The Nasdaq 100, as I said before, it's comprised of the 100 largest non-financial companies listed on Nasdaq. It's been around for the better part of 35 years. Back in 1998, the index became modified market cap. Since then, special rebalance. And then talking about market performance and technology, it's really interesting here. We're showing the index price level in purple, showing the sales price per share in blue, and the PE in orange. So it's extremely noticeable here is that, of course, first and foremost, you've got the bottom left to the top right, showing NDX index performance, exactly what you want to see. Companies showing the index showing great performance, but at the same time, PE has actually been relatively stable, and sales per share has sales per share has also been skyrocketing along with that performance. So what does that really mean? Fundamentals are driving the recovery, and they're really driving the growth, which is huge. And at the same time, valuations are really actually coming down. There's some interesting information here. Looking at on the left side, and it'll be slightly a little bit different than the following slide. This is showing just the pure price return performance of the Nasdaq 100 versus the S&P 500. On the left side, it's on an annual basis, and on the right side is cumulatively. You can see lines in blue are the Nasdaq 100, lines in gray are the S&P, and over the last decade. 9 of the last 10 years, the Nasdaq 100 has actually outperformed the S&P 500, and that story is actually the same here. But on this slide, we're actually showing the total return performance. Now, what does that mean? It's dividends that were reinvested, and a lot of people had a very tough Q4, myself included. But the Nasdaq 100 still actually ended up positive, just barely, 4 basis points. The S&P 500 was down just over 4.5%. Correlation, something that we tend to use quite a bit in statistics and comparing index performance, which is actually pretty high between the Nasdaq 100 and the S&P 500. And that's really not surprising, but for a number of reasons. Number one being, a lot of the companies in the Nasdaq 100 are actually in the S&P 500, right? So it makes a ton of sense. There's going to be a lot of correlation there, but they also represent the U.S. equity markets. So again, you're going to have that very similar performance. So that actually makes a ton of sense. It also should follow that Nasdaq 100 should actually have higher volatility because we have fewer names, so there's slightly less diversification. But with that, you actually have the chance for outperformance. You're able to actually get more of a substantial more weight to some of those names that you actually want to have a higher weight to. So there are pluses and minuses when you're looking to get exposure to indexes in smaller or larger size baskets. Looking at the historical volatility, this is actually these are the implied volatility indexes that the CBOE calculates on both the Nasdaq 100 and the S&P 500. In the blue, is the Nasdaq, and in gray, it's S&P 500 again. Shown here, and this is one of my favorite slides that I pulled together for today's presentation. It's showing on an annual basis the 1-year excess return for the Nasdaq 100 versus the S&P 500. That's in blue. And in gray, that's the differences in the 1-year volatility. Now, I'm going to break down really quickly what this means. Anytime the blue line or the gray line are above 0, that means the Nasdaq 100 has a higher figure. So if you look really closely, in most instances in this chart, the Nasdaq 100's really been a high performer relative to the S&P 500. notwithstanding towards early 2013, by and large, we've had very, very substantial, consistent outperformance on a one-year basis. The 100 that make the index. Now, this is where I was kind of getting at before. It's not just the Apples and the Amazons and the Microsofts that are driving this index. The bottom 50 are actually outperforming since the financial crisis. So that's actually what that chart shows there on the bottom right. On an equal weighted basis, we looked at the performance of the top 50 versus the bottom 50. And the top 50, while extremely great performers, still actually underperforming the bottom 50. And that's huge, right? You don't necessarily want to think of this index as just being comprised of those names, because it's not. And that's what's critical. We do have plenty of other small cap names in here, and really, I shouldn't say small cap, smaller large cap names, and we'll get into that in just a second, about the market cap size and what does it mean and where this index actually stands. But the bottom names that are all pretty much large cap give you that indication and performance that you'd want to see. Similarly, on the left-hand side, we're actually comparing the top 50 and the bottom 50, looking at price ratio. So the top 50, again, are in blue over here, the bottom 50 in purple. The decade of the Nasdaq 100, as we were saying just a few moments ago, the Nasdaq 100 has been on a great tear, and shown here, looking at the 10-year sales growth across each industry. In addition, looking at the industry breakdown. Now, where is that sales growth really coming from across industries in the Nasdaq U.S. Large mid-cap benchmarks? Not surprisingly and interestingly enough, technology, healthcare, and consumer services, where the majority of the weight in the Nasdaq 100 is comprised, are having the highest sales growth rates. And again, that goes back to what I was starting off the presentation with, that technology is not just an industry classification. Technology underpins every company in every way they interact in the markets. And it's critical to think, just because a company is classified as technology, it doesn't mean that they're not a part of technology. They're not using technology. And that's what, when we think Nasdaq 100, when we think Nasdaq, that's what we think. Shown here some information, some data points about top performers and the highest year-over-year growth in earnings and the top 10 names in each. So slightly outdated information, but interesting to see that some of those names you might have heard of. Some of them are bigger than others, but some maybe not have heard of. And this goes back to the top 50, bottom 50 aspect. So companies like Illumina, O'Reilly, and others, right? That Netflix is in there too, right? So you get that good mix on companies that had a great year-to-date performance through the end of November. And this is what I was getting at just moments ago. The Nasdaq 100, very interestingly enough, has their smallest company in the Nasdaq 100 has the smallest company is actually larger than the smallest company in the S&P 500. So when people say the S&P 500, it's meant to represent the U.S. large cap space, well, the Nasdaq 100 smallest companies are actually bigger than the smallest companies there. So yes, we are in fact a large cap index comprised of companies. Technology, consumer services, and healthcare, predominantly biotech within healthcare, are the drivers and from a weight perspective. Interestingly enough, here on this chart, I'm showing the weights. Again, this is through the end of the year, so with the inclusive of the holiday weeks and really vast underperformance in the month of December. You can see that contribution to index return and where that came from. You can see the pure return and how each of those companies and within each of those sleeves performed. And then lastly, the year-over-year benchmark returns for each of those industries. So if you look at, again, across the one-year performances of each of those indexes, technology, consumer services, and healthcare are actually three of the four best performing industries. So the one aspect here, utilities actually happen to be the second best performing industry. Other than that, three of the top four that represent the majority of the weight within the Nasdaq 100 were the outperformers. Again, sector exposure matters. This is the story of what I've been saying last slide. I'm going to say it again for another couple slides. That you can see again that this is on a global scale, comparing all the 10 ICB industry classification benchmark industries, how they performed over the last decade. And you can see again that technology is in the lead. You can see that consumer services and healthcare are very much second and third. And this is just something we like pointing out, because the Nasdaq 100 does not include financials within the index. We like to point out that on a U.S. or global basis, technology is where it's at from a performance perspective, right? In purple, you have U.S. In orange, in the lighter orange, you actually have global tech, and then in the blue and the dark orange, you have U.S. and global financials. Continuing on the theme of fundamentals, and we're going to get some more of that in the next couple of slides as well. Industries and dividends over the last decade, technology, and it really surprises people every time we show this slide and talk about this type of information. Technology is really where dividend has grown over the last decade, at 240%. It's been phenomenal seeing that transpire. And that it didn't start with Apple. It certainly helped when they started paying dividends about 7 years ago. They're obviously a big player in that, but tons of growth in the dividend space with technology. Close with two more slides on fundamentals. Since 2003, so just over 15 years, and this is where I'm looking at the third bullet point, the Nasdaq 100 is a compound annual growth rate really across everything you'd want to see, of over 20% in earnings, up over 14% in revenue, 20% in dividends, and at the same time, PE has contracted at over 10%. Lastly, this is showing on a cumulative basis three of those factors, looking at earnings and revenues and dividends. Really interesting, shown here, and it's important to note the Nasdaq 100 versus the S&P, showing how much more we've grown across all three factors. And with that, I hand it over to Sean. Thank you.
All right, thanks a lot, Efram. That was a wonderful representation of what the Nasdaq 100 has to offer on a fundamental level, and with the performance data that we were shown in the past here. And we're going to talk a little bit about the Nasdaq 100 index options. But before we get to that, we do have a poll question, and I might ask for some help from Don here, as I don't think we went over exactly how to perform the poll. But that would be roughly what percentage of your portfolio is technology weighted or potentially inside the Nasdaq 100. I'll give you a few seconds to enter in your responses now. And Don, if you could help me gather some of those and kind of get the answers to that question, that would be wonderful. So we'll move along while we're getting the answers to that poll, and we'll jump right into it. And the first thing I'd really like to speak about is how you're looking at your overall portfolio. For investors who are holding a portfolio, when you're weighing those components that comprise it, that return profile will resemble that of an index. Going back, I guess Don had that poll question right back in here. Do we have any answers for that, Don? All right. Okay, we're coming up. This is good. I'd say that we're looking in the B range right now, and certainly getting a couple more responses. So we're looking right around that 25 to 50% level for a portfolio. I'm gonna stop the poll now, and I am curious to hear about the makeup of some of those portfolios themselves. As let's see, we're gonna. Oh, apologies there. I did close it, Don. We're gonna move along, and going back to how you're looking at your portfolio and weighing the components, and that they are going to resemble an index. The total return of any given portfolio, the real metrics from a statistical standpoint that I want to talk about a little bit are both beta and correlation. Beta would be the impact of an index or a portfolio against a benchmark. And talking about benchmarks, we're going to speak about indexes as those benchmarks, and the NDX being one of those indexes, and highly correlated portfolios to an index, and portfolios that have that broad-based
Sean, it appears we've lost your sound. You might want to click your mic again.
It's a test.
There you go. You're back.
Are we good?
Yep.
All right. Okay. I don't know where we cut out, so I'll just go through it again as far as looking at the portfolio and weighing the components of that portfolio, noticing that the return of the portfolio overall will likely resemble that of an index over time. If you put your entire portfolio into a basket, track it against a benchmark, it may be slightly more volatile or less volatile, dependent upon the beta of your portfolio versus that index, and that would be the relative performance of your portfolio. And beta can be positive and negative, just like correlation can be positive and negative. And we'll get to some of those a little bit later. Portfolios having a broad-based exposure in companies focused on innovation do tend to have a strong correlation with the Nasdaq 100 index and the products inside of it. And we will be talking about how options can be used to minimize risk and protect the value of portfolio, specifically around shifts in volatility. And when we see a market downturn like we saw towards the end of the fourth quarter of last year, being protected certainly does help. So the Nasdaq 100 index options products are tradable products. We have two of them. We have the NDX, which is the larger index itself. It is Nasdaq's flagship index product that trades on 3 of our options exchanges, and you can certainly trade these index options through TradeStation. The trading symbol is NDX. We have monthly serial AM settlements on the 3rd Friday of every month, and PM settlements for weekly options. We also have a Wednesday settlement inside of NDX. We have NQX, which we launched last year in July. It's a 1/5 notional value of the Nasdaq 100, the NDX. So it is exactly 1/5 the price. If NDX is $7,000, NQX is $1,400. It does trade under that symbol, NQX. And we have monthly and weeklies, all PM settled. They are all European style options. And what I mean by that is that there is no early exercise of options prior to expiration. They can only be exercised at expiration. They offer cash settlement, which is very interesting. So rather than deliver a physical security, you're going to receive a cash payment at expiration with no risk of forced delivery. NDX and NQX are joined with our partners at Invesco PowerShares with the QQQ product. That's the ETF that tracks the NDX itself. Options are available to trade on the QQQ as well. So if you have a larger portfolio, perhaps NDX might be an option. If you have a medium-sized portfolio, perhaps NQX is an option. And if you have a smaller portfolio, perhaps QQQ would be an option for a portfolio hedge. Also, in terms of index options, it's an easy profit and loss calculation. Each index point is equal to $100. And there are potential tax advantages to trading index options versus trading ETF options. That is a tax rule 1256 of the IRS tax code. Favorable gains as far as your capital gains will be taxed 60% long-term and 40% short-term capital gains, regardless of holding period. Typically, to get a long-term capital gain, you'd have to hold the security for a year or so. I do want to remind you that I am not a tax professional in any way, shape, or form, and to consult your tax advisor when looking to take advantage of the 1256 stipulation inside the IRS tax code. Portfolio hedging strategies, very simply, what we're looking to do here is protect the value of your portfolio. I'm assuming that your portfolio is going to be that of long securities, and that those securities are going to appreciate as the market increases in value. The easiest way to protect against the market moving lower would be to buy downside puts. The three types of downside puts that you can buy, if we're going to simplify things, would be that of a low delta, something that is near the money, which would have a medium-sized delta, and something that is in the money, which would have a higher delta. Lower delta options would be a little bit further away from where the index is trading currently. If, for example, the Nasdaq 100 were trading at 7,000, to buy a put option on the 6,500 strike would likely be a lower delta. Something close to at the money would be the medium delta, and then something in the money would be high. Use your own judgment naturally to prepare for market losses, or to time the market, or to protect yourself against systematic events. And the max profit for buying downside puts would be equal to the strike price minus the premium that you did pay for these puts. Mind you, puts are a type of insurance on a portfolio, in that you are going to be paying a premium, and that premium does come at a cost. Buying downside puts are the easiest way to protect your portfolio. Again, I do want to focus on the fact that there are costs that are associated with it, and that options by their nature are a decaying asset over time. So we have the profit and loss graph. As you can see, as the index goes down, and we're talking about NQX right now, as we're looking into more of a retail portfolio, this would be the index option that may be most suitable for your portfolio. And as the index decreases, you will see at a 1-for-1 basis, once it hits the strike price that you purchase those puts on, that you will see the benefits of purchasing those puts from a P&L perspective. So to offset the cost of buying puts, you can certainly sell upside call spreads. You can combine these two strategies by buying puts and selling upside call spreads. I would say that you could also sell upside calls. However, there are significant margin ramifications to that, as the disclaimer did state that we are not in any way, shape, or form suggesting any strategies for the portfolio itself, and that you should be making those decisions on your own. But selling a call spread would generate income by collecting the premium that the buyer of that spread did pay for the spread itself. An upside call spread would be created by selling a call on a lower strike, and then purchasing a call on a higher in the same term structure, or the same expiry, or with the same expiration date. The max loss would be the difference between the two strike prices minus the premium collected from the spread, and that, as I mentioned earlier, that the strategy can be employed to offset the costs that are associated with buying that downside put. So this is the profit and loss graph for selling a NQX call spread. And kind of going back to your portfolio itself, and where these index options might be appropriate. NDX with a $7,000 notional value would be reflective of a full portfolio of $700,000, and QX would be more reflective of a portfolio of around $140,000, and QQQ would be 1/8 the size of NQX, and probably somewhere in the neighborhood of we'll call it $17,000. So I do want to stress once again that ETFs will have a physical delivery aspect to them, and that if you are hedging a portfolio using an ETF, that at expiration you may be forced to take delivery of that ETF, or be forced to deliver that ETF if you were buying puts and you were short, would translate into a short stop position. So buying downside put spreads is another way that you can protect your portfolio itself from losses and the market moving downward. Now, I will say that this is an impure hedge, given that the max gain of a put spread is going to be the difference between the two strike prices that you choose to employ this put spread minus the net cost of the spread that you paid, and that the max losses would be the spread that you paid. So for a systematic event or a significant market downturn or a significant market event that takes the entire market down a bunch, you're not going to receive the same benefits as you would if you were to own a put on its own. The max loss is the cost of spread, right? So you as far as employing a put spread, purchasing a put on a higher strike than the put that you're selling, puts are going to profit as the market moves down, and you can certainly have some protection inside of your portfolio for that. There are some more complicated strategies and ratioed strategies that you can employ using options that I'm not going to go into here, as far as butterfly spreads or ratio call spreads and ratio put spreads, that could be a little bit more intensive, and a deeper understanding of options trading and volatility profiles might be necessary in order to use those to employ to protect your portfolio. And as Efram alluded to before, the Nasdaq 100 has traditionally traded at a slightly higher volatility than the S&P, and as a result of that, when you're selling upside call spreads, you might be getting a little bit more of a more punch inside of the call spreads that you're selling. So as your portfolio moves up and down, as the market moves in a dynamic fashion, I think what I'd like to really employ, at least discuss, and certainly open to questions from the audience broadly as to how best to protect your portfolio, would be to consider the overall value of your portfolio, and then the maximum loss and the outlay that you would be taking through insurance policy type options trade to protect it. And if you're looking for any more information on NDX, the index options themselves, we are definitely here for you. Sales@nasdaq.com. I will see those personally anytime you were to send an email that way. And thank you for your time. At this point, I'd really love to open it up for questions, and I imagine I'd be seeing those questions right here on the application that we have the webinar.
Yeah, that's right, Sean. And so if anyone has any questions, please type them in. We've got time, and we really want to get to the bottom of things that are on your mind. Okay, George is asking about the skew between the NDX and the SPX.
George, thank you very much.
I'm going to say, well, the SPX is a CBOE product, but...
Well, I'll talk about skew from a perspective of a product with higher volatility and a product with lower volatility, right? So the skew of a product with lower volatility will tend to be steeper, which would mean that the volatility profile of the downside would tend to be of a higher volatility than the at the monies on a relative basis to something that has a higher volatility profile in the at the monies, which will have a flatter skew in general. That said, when it comes to the NDX, and if you're looking to buy put spreads, they can potentially have a less steep skew profile inside of the trade itself.
Anything else, TradeStation traders? Mark brought up an interesting question a little bit ago about how to actually get the cash indexes in the radar screen, and you do need to lead the symbol with a $sign for those. I don't see any more questions, or it looks like there are some coming.
To talk about NQX a little. NQX is traded on the ISE, and we launched it back in July. And some of the feedback that we've gotten on NDX and on NQX itself is that these options they look like they're really wide. But when you're looking at NDX and you're saying that this is a $7,000 index product, when you see a market that's $2 or $3 wide, you're really talking about something that is very tight. It's 40 times the size of the Qs. $3 wide in NDX is the equivalent of 7 cents wide in the Qs, right? So, or 7.5 cents wide in the Qs. And if you look at the overall liquidity that's available at the screen price at the same time, there's just so much more liquidity that's available in the NDX options landscape. And then NQX, you're probably looking at around 7 or 8 basis points wide, and on the screens. And when you're routing index options to the exchange, there is always the opportunity for price improvement. And as to Frank's question here, that can these be done in an IRA? I would consult your financial professional on whether or not they can. I think it's dependent upon what type of IRA it is, that I can personally trade options and index options in my own IRA. So to answer that question, I think that's right.
I think you covered everything, Sean. I want to thank Sean Feeney, the Senior Managing Director of U.S. Option Sales at the Nasdaq Global Trading and Market Services, and Efram Slen, the Director of Product Development at Nasdaq Global Information Services, for their time today in these presentations. As you can see, there were two very neat presentations built within the same half hour or 40 minutes that you spent with us. We hope that it was helpful and that you will find these products useful in your trading as we move forward. As always, I want to thank everybody for their time today, spending time with us at TradeStation. We put these events on because we know that everybody connected with TradeStation wants to be a better trader. And so we welcome you to all of these events. We hope that we want to welcome Sean and Efram back at some future time for another area that they specialize in. And certainly join us tomorrow morning, 1/2 hour before the market opens, for the TradeStation Morning Market Briefing. I'll be here with Andrew Horowitz, and we hope to get you off to a really good start to your Friday trading. Sean, thanks very much. And hope you take up that invitation and come back again.
All right. Thank you very much again, Don, and it was an honor to be here.
Thank you very much.
All right, Efram. Hey, all right, everybody. Have a great afternoon. Trade well.